Principles of Accounting 1, Chapter 4. So in Chapter 4, we stopped talking about service companies and we're going to talk about a merchandising company. So we've been talking about service companies where we have revenues minus expenses equal net incomes. Service companies sell time or services in order to earn revenue. So examples, accounting firms, law firms, plumbing, electricians, hairdressers, all of those things where they're selling a service or time to earn revenue. A merchandiser is a business that sells merchandise or inventory. So we buy already made products and we sell them to people. So we buy from a wholesaler. A merchandiser buys from a wholesaler who then sells to customers. Examples of retailers or merchandising retailers are Target, Walmart, Dollar General, Hy-Vee, Fairway, Casey's. All of those have purchased merchandise from manufacturers or wholesalers and then sell those finished goods to consumers. When we're going to start talking about the operating cycle of a business, we'll also talk about the cash cycle of a business. So what the operating cycle is when we purchase inventory until we collect cash from customers. So we buy inventory from a wholesaler or from a manufacturing company. We put it on our shelves to sell. A customer comes and buys our inventory and they either pay us in cash or we have an accounts receivable where they agree to pay us at a later time. Then when we receive cash from them, that is the end of our operating cycle. We add to the income statement when we are working with inventory. So the cost of merchandise or inventory sold to customers is called cost of goods sold. So our income statement has gone from sales minus expenses equals net income to sales minus cost of goods sold equals gross profit. And gross profit minus expenses equals net income. So this would only be true of a company that is selling inventory and not just services. So this is an example of the income statements of a service company versus a merchandising company, showing this addition of cost of goods sold and the gross profit. Okay. On the balance sheet, in our assets section, we then have merchandise inventory. Okay. Merchandise inventory as items are posted in order of liquidity. Because we hope to turn inventory into cash, inventory is often placed after accounts receivable before other current assets. Okay. There are two types of inventory systems that businesses can use. The first is a periodic inventory system where everything is done manually by hand. So the physical counts of inventory we do by hand or by manual processes. Or a perpetual inventory system, which is a computerized inventory system. We will, in this class, be focusing on the perpetual inventory system, which runs a computerized record that continuously updates our inventory every time an item is sold. Okay. When we purchase from another company, we purchase inventory to sell, we get an invoice. Okay. So invoices are also called bills. So we are being billed by the supplier to pay them for the purchase of the goods that we're going to be selling in our store. This is an example of a purchase invoice. So we have a company that has bought 100 touchscreen tablet computers from a wholesaler, and we are looking to sell them. There's a lot of different information on this. So we have who did we buy from? What is our company name? We have the date of the sale, the number of the invoice. So this is a record keeping tool for the company selling the inventory. We have the number that we purchased, the price per unit, so the total amount that we have to be paid. And then we have this extra thing here called credit terms. What credit terms are is a type of payment term that companies use to incentivize people to pay earlier. So if we would buy this, we would create an accounts payable in our accounting records. So we're buying these on credit and not paying cash for them. What this company, Southwest Electronics Direct, is telling us that if we pay that within 15 days, they're going to give us a 3% credit. And if we take the full 30 days to pay it, we have to pay the full price. So you can see the amount here, this $33,950 is that 3% discount that we're going to be getting if we pay it early. This, again, is what I said, a tactic that people use to get you to pay them sooner to help their cash flows. Okay? When we purchase merchandise inventory, whether we pay for cash or accounts receivable, we record an asset because we have received inventory. So here we have that we received goods from purchase. We made a payment on that date. So we got 100 tablets at a total value of $35,000, and we paid cash for that inventory. Okay. We talked about this purchase discount. So it's a discount that businesses offer as an incentive for early payment. Those are called credit terms. So those are the payment terms of the purchase discount. Most credit terms express the discount time period, and the final due date. For example, 315 and 30 means a 3% discount if paid within 15 days. Otherwise, the full amount is due in 30 days. That N stands for net, which means net due. Okay, so example of this, 210 and 30, the discount is 2% if we pay within 10 days. Otherwise, the net or all of it is due in 30 days. Okay, so we have this graphic here showing the discount period for the amount of the discount, or if we pay the full invoice price. Okay. If we did pay, so say we paid cash within that discount period, so if we had instead recorded a accounts payable for $35,000. So in the original journal entry, we had merchandise inventory with a debit and a credit to cash. If instead that had been a debit to merchandise inventory and a credit to accounts payable, then when we pay this within the discount period, this is what that journal entry would look like. So we remove the entire $35,000 in accounts payable. We're going to pay $33,950, which is the $35,000 minus 3%. And then we're going to reduce the value of our inventory by 3%. Okay. Then on, this is a purchase with a discount example. So here we have, we purchased $500 worth of merchandise inventory on account. Credit terms 210 net 30. So we have debited merchandise inventory and credited accounts payable for $500. Then on November 12th, we pay the amount due. We get our discount, our 2% discount for paying early. So we are going to debit accounts payable for the full $500. We're going to credit merchandise inventory for the discount, and then we're going to credit cash for $490 for the payment. We can also return goods. Okay, so Returns exist when sellers allow purchasers to return merchandise that is defective, damaged, or otherwise unsuitable for any reason. And allowances are amounts granted as an incentive to keep goods that are not as ordered. So, for example, if you purchase something that is like a second hand or it's a scratch and dent sale, that would be a purchase allowance. Okay, this is an example of a purchase allowance where we have issued a $30 debit for an allowance for defective merchandise. So we would, they're saying that because that merchandise is defective, we don't have to pay them as much money. So we would reduce our accounts payable by that $30 and our merchandise inventory by that $30. Okay. If we had a return, then we would record the full amount of the return. So we have this example here where on June 1st, we purchased $250 worth of merchandise. So we debit merchandise inventory for $250 and credit accounts payable for $250. Then on June 30th, we return $50 worth of those goods. So we debit accounts payable for $50 and credit merchandise inventory for $50. So we need to reduce both of those accounts. Then we pay on June 11th within the discount period. We now only owe them $200 because we returned $50 of the original purchase. So we take our $200, we debit accounts payable, we credit merchandise inventory for the discount, and we credit cash for the cash payment. Okay, so we're looking at an example here. On June 10th, we purchased 15 tablets on account with credit terms of $315 net 30 at a cost of $5,250. 5 tablets are returned on June 15th, and then a payment is made on June 20th. So if we look at these journal entries, so I'm going to exit out so I can, or escape out so I can type on here. So we have the journal entries. The first entry is going to be the receipt of the merchandise. So the receipt of the merchandise is, we're going to debit merchandise inventory for $5,250. And then we're going to credit accounts payable for $5,250. Then on June 15th, we're going to return 5 of those. So we're going to debit accounts payable for the amount of the return, $1,750, and we're going to credit merchandise inventory for $1,750. Okay. Now we have a balance of 12 $3,500. Okay. Now on the date that we pay, we are going to debit accounts payable for the full amount remaining, so the $3,500. We are going to credit merchandise inventory for the discount for paying early. Okay, so we get a 3% discount. So we take $3,500 times 3%, which is $105. And then the remaining amount is paid in cash. So 3,500 minus $105 is $3,395. Okay. We will continue chapter 4 in the next